investors, and welcome back to Stocks to Watch. 2026 is already shaping up to really be a pivotal year for investors. Gold surged to record highs, silver moving in what many are calling a parabolic trend. And at the same time, global macro risks continue to build beneath the surface. So, to help us make sense of where the precious metals markets may be headed, how investors should think about positioning right now, we are joined today by Don Durrett, a gold and silver mining stock analyst and the founder of goldstockdata.com, a research platform widely followed by serious metals investors. Don, it is always great to have you on our show.
Yeah, well, we do this monthly, Ashley, so it's not a new thing.
Yes, yes. And what I really enjoy is every time I speak to you, and then the next time I speak to you, what you predicted was right. So let's start. What are the key macro events, data releases, structural trends you're watching most closely right now when it comes to trading gold and silver?
The S&P 500, I mean, for me, that's the most important chart because gold has been following the S&P 500 since February 24. So we're basically 2 years now. We're going plus that, where they basically been correlated. They're not supposed to be correlated, Ashley. Something's wrong here.
Mhm.
Um, as long as the S&P continues to go higher, and I think it will here in January and February, gold and silver are going to continue to go higher. They just, whenever gold is more volatile than the S&P, so gold is corrected over the last 2 years, is corrected more often than the S&P. But every single time gold's corrected, it just turn around, it just follows S&P back up. We had a 12% correction in October, and it just come right back up and followed the S&P.
Mhm.
And that, I think that, so nothing's going to push gold down except the S&P. It's nothing else. Nothing else will push it down, and nothing's going to push down silver except gold. So we're following the S&P very, very closely here to see, when the next correction comes. I personally feel that, I think you mentioned this is a pivotal year. This is a uber pivotal because it's an election year, because I think that Trump is going to basically lose his mojo, because I think the Democrats are going to win either the House or the Senate. So Trump, the Republican Party, there will be no path forward politically for any solutions, because both sides have different values now. And so we're heading into a train wreck, if you will. So it's a matter of, when does the S&P figure this out? The S&P is usually about 6 months ahead. So somewhere April, May, June, I think the S&P will stop going up.
Uh-huh.
But the first quarter here, maybe the S&P will, we might have some volatility in March, maybe a little in February. I'm not expecting a lot in the rest of this month or in February, not a lot of. So basically, kind of the coast is clear right now for investors, if you will, but it won't last much longer, meaning that we don't really have to worry, I think, about a significant deep dip here in January, February. But once we get to March, then we have to start thinking about it. But gold is really the truth teller here. Again, the S&P and gold should not both be traded at all-time high. It's like cats and dogs, it just, they don't go together well. And so gold, I think, is telling the truth here. And I don't think that we have to worry too much about any deep corrections in gold this year. Gold is, I believe, the buy the dip asset.
Mhm.
And I think any dip it does this year will go higher. I think we'll end the year above 5,000, and potentially significantly above 5,000, which is kind of mind blowing, considering we started the year. We're up $300 already. So gold is definitely the asset. It's been the number one asset. I mean, so it went up 27% in 24, and then it went up, I think, almost 70% in 25. And this year it's probably going to be up 30%. And that would be, over 5,000, somewhere in there, 20 to 30%. I don't think it'll go much more than that. But so silver, on the other hand, it's basically has become a monetary metal. And once it became a monetary metal, its whole dynamic changed. So silver, I mean, it went from $35 at the beginning of August to, as we speak, the current spot is 93.
Yeah.
And just that's $35 to 93 since August 1st.
Mm-hmm.
And the reason why is because it became a monetary metal. Once it became a monetary metal, there just wasn't enough of it.
Mm-hmm.
Once the investor said, "Oh, I want some of that," it's basically a giffen good in that it becomes more valuable the higher the price gets. It's a very strange asset. Nobody wants to own it at $20, but everybody wants to own it at 50, 75, 100.
Mm-hmm.
The demand is actually increasing for silver right now. It's going higher. So silver's at 93, and every dollar goes up, the demand goes up. And the reason why is because there's not enough of it. There's not enough physical silver. And once the investors come in, they start squeezing out the fabricators. Silver, there's about 800 million ounces of silver that's mined a year. The fabricators, the people that make our phones and our cars, they need 700 of the 800. They need to all the silver that's produced annually. It's all needed by the solar panel. 700 million ounces. It's needed by the fabricator. 700 to 800. There's nothing left over for the investors. Mm-hmm. So for the last 4 years, we've had deficits of over 600 million ounces. And this year, the deficit is projected to be 300 million ounces. Mm-hmm. So you have 800 million ounces produced, 200 million ounces recycled, and demand last year was 1.2, approximately 1.2, 200 million deficit. This year, 1.3, 300 million deficit. That's 500 million ounces. It has to be found somewhere above ground inventory.
Yeah.
Running out of silver. We're running out of these 1,000 ounce bars. Now, there's a whole bunch of silver that can be recycled, especially like silverware. There's unbelievable quantities of silverware. People wanted to turn it all in. And they can melt down the coins. There's a lot of those. They can melt down like, pre-64 silver coins. They can melt all those down. But there's not enough silver for investors. So silver is going to continue. Like I said, if the S&P's up, silver is just going to keep ripping. There's nothing to slow it down. Mm-hmm. The only way we're going to slow down silver, well, we cover the shorts. So the shorts is pretty significant. We don't know. It's not very transparent, who's short exactly. The COMEX is not transparent at all. So we can ask the AI prompts and try to get an idea of, how much they're short. It's really the key here is the net short of the commercial banks. And can they close? And so we're still in a squeeze right now. It's slowly they're getting out of their net short position, but it's still open. And so we're going to still see this squeeze higher. So it's hard to say what's going to happen when the squeeze is done. There's going to be a lot of volatility in silver, no doubt about it. But the key here is gold. If gold continues to trend higher, silver will follow. So even if they beat up silver and they find a way to get it, down like $20 in a single day, they won't be able to keep it down if they can't control gold. So if gold's trending higher, silver's going to follow. It always does. So it's going to be really hard for them to push silver down and keep it down, or push gold down and keep it down, because the macro factors for gold have only been getting better. And we can talk about why.
Yeah, well, absolutely. And, speaking of the current environment, I just have to ask, the Financial Times describes it as risk on in metals and risk off in macro, given everything you've just talked about. Do you agree with that assessment? And what forces are really driving this divergence?
I don't think they said that. I haven't read that headline or whatever, but we're in a risk on environment for macro in that you own stocks when you're going to take on risk. So you own technology. So when you own technology, that is actually a risk on trade. Risk off is when you own utilities. So we're in a risk on environment right now on Wall Street, a fearless environment. So risk on is when there's no fear. That's when you're overweight stocks. Like right now, the boomers are way overweight stocks and they shouldn't be. It should be a risk off, but nobody believes the macro. The macro says, the headline's right, this is a risk off environment, people. The macro sucks. But Wall Street, if you listen to Wall Street, the narrative is that the macro is great, right?
Mm.
But it's a narrative. It's a narrative, and it's a false narrative. They keep pointing to GDP. GDP is at 5%. It's the consumer spending. Everything's fine. But you need to look at the numbers holistically. If you look at them holistically, they're ugly. For instance, the irony of GDP is that when our imports go down, our GDP goes up. It's totally, it's not intuitive at all. But that's a fact. So Chinese imports went down and GDP goes up. We spend $7 trillion. The federal government, these aren't just state. The GDP is both state and government spending.
Mm-hmm.
The Fed spends $7 trillion. GDP, what? It's 27, 30. We count that as GDP. It's insanity. So it's like if you're a business and you go and borrow money and you call that revenue, that's what it's kind of the government does. They're like a business that goes and borrows money and calls it revenue. It's like, what the heck's going on here? Now, historically, it hasn't been a problem because we haven't had $2 trillion deficits. But when you have these massive deficits, it pumps the hell out of GDP. It's totally misleading. Then the third factor that makes it even more misleading is that all that money that's being spent on these data centers, and it's a lot, right? It's trillions. That's counted as GDP. But it only helps a small little group of people, these small little companies, right? And the people that are building them, of course. But overall, that CapEx spending doesn't help the entire economy. Mm-hmm. That 5% number is total BS. We're not even close there. We're probably under 2% and probably under 1% if you really look at it from a holistic standpoint. The economy is slowing. There's no green shoots out there. AI is actually negative for the economy. The reason why it's negative is a job killer. Mm-hmm. Like right now, your job, right? What you do, Ashley, is kind of at risk. Mm-hmm. Because now we can use AI. We don't need you. We can create a fake Ashley and just write a script and let her talk, right?
It's crazy. So
exactly. We can have AI. That's just one example. But I would 10%. At least 10% of the workforce, their jobs are kind of at risk because of AI. Mm-hmm. It's a job killer. It's not a job winner. And now they're trying to figure out how they monetize this stuff. They don't even know if they can monetize it. ChatGPT pretty much came flat out and said, we're not only going to not make any money the rest of the decade, but we're going to lose money. They're the largest AI company. Yeah. They flat out said it. I mean, they told the people, we're not going to make any money for the rest of the decade. Case closed.
Case closed. Okay, so I want to talk about interest rates now, and where do you see the U.S. dollar heading from here, and what do you think that implies, not just for gold and silver, but really for the financial markets and more broadly?
Yeah, you just opened a can of worms, Ashley.
Okay, here we go. Because guess what? I'm going to talk about the market crash next.
Yeah, you opened a can of worms.
Okay, let's go.
The dollar and the U.S. bond are in deep, deep trouble. This is my personal opinion. Mm-hmm. Deep, deep trouble. And the reason why is because we are the reserve currency, and we have been exporting our debt. And as we export our debt, we basically, we import goods, we let the rest of the world make our stuff, and then we sell them our debt, and then they basically take our cash from our net imports that they get, mercantilist economies, and they buy our debt. And now they're stopping. They're no longer buying our debt, and so you're seeing basically our consumers of our debt is slowly evaporating, and it's getting worse and worse. And the dollar has been, since it's a global reserve currency, these central banks use them as reserves. So they hold our bonds as our reserves. And since the Ukraine war started, that slowly has been reversing, where not only are they not buying our debt, but they're selling our debt. And so that's putting negative pressure on the dollar. So the dollar's been hanging in there because the U.S. economy has been hanging in there. It's been the strongest economy. And now our stock market is somewhere between 60 and 65% of all the global stock markets combined. It's way overweight. And so what's coming, I firmly believe, is that you're seeing a complete revolutionary epic situation here where if the US economy falters and we go into recession and the Fed cannot get it back on its feet. So, and the only tools that the Fed really has is to cut interest rates, but they can only cut them so far, they'll create inflation, or print money and they can only print so much, or they'll create inflation. Inflation is basically the kryptonite of debt. You're just going to destroy your currency and you can't service your debt anymore. So the Fed's losing its tools, and I believe we're heading into recession. Once an economy starts to slow down, it's almost impossible to reverse it, and we're slowing. We're seeing that in the jobs numbers, where the number of new jobs are being created, and so now we're slowing, and then the housing market is slowing, and so we're seeing prices go down, we're seeing inventories go up. That's a problem. And then Trump's throwing these tariffs on, and so the tariffs also create headwinds. So the Chinese, they're importing less. They're like, well, the Americans aren't going to buy these products at these tariffs rates. We won't even send them. We're not even going to send them. So they're not even sending them. They're like, because they'd have to raise the rates. They basically said they won't buy them, so let's not even send them. So imports from China are way down. So these problems are increasing, and Wall Street is like, no, don't worry, everything's fine. We have this American exceptionalism. We're the number one economy. We're going to keep creating. We're going to keep innovating. And you hear from the Trump administration, don't you worry, we have all this money that's coming in from the foreigners. They're going to build all these plants. Nothing to worry about. Well, it's a timing thing. How long does it take before the GDP really starts to ignite? Because they built these plants, but they don't build them overnight. And when things turn, and so the dollar is under pressure here. Now, I think it will bounce a little bit when the recession begins, and you have a flight to safety. But the Fed will immediately start printing money, so the bounce will be very short-lived, and it might not be even very, very high. Maybe the DXY gets back about. It'll probably get back about 100, 101, 102. I think it's about as high as it'll go. And then it'll turn around and reverse, and then back under 100, and then Katie bar the door thing, because once we go into recession, you have about 20% of our stock market is foreign money. Back in 1989, it was the same situation for Japan, where they had 50% of the global stock market, and over 20% was foreign money, and their stock market crashed because all the foreign money left. I think the same thing's going to happen to us. The foreign money is going to leave. It's basically hot money. And then the boomers are way overweight the stock market. And they basically, they've been making so much money over the last 15 years that when they retired, they're like, let's just let this baby ride. We're doing great here. And so they've let it ride. They haven't walked away. And so they're overweight big time. Well, they're gonna get off the boat fairly quickly. So you have a lot of hot money in the stock market.
Yeah.
And so the dollar, by the end of this year, I think is in deep, deep trouble. But I said you opened a can of worms. So it's not just the dollar that's the problem. It's also the bond market. When the bond market becomes fragile, it's because we're borrowing 150 billion plus a month just for the deficit. But then we're also borrowing 2x, 3x, 4x that to roll over existing debt, because Janet Yellen was borrowing all the money at doing less than 1 year. So it all has to keep getting rolled over. And now Bessent's been doing it for 2 years. So we had like 3 years of one year borrowing. That's like $6 trillion. So it just keeps getting, so the rollover just keeps getting bigger and bigger and bigger. So they have to borrow something like $6 to $10 trillion every year to roll over that money. And so where's it going to come from? But that is slowly impacting the overall liquidity in the economy, because that's sucking it all up. And so I think that we're heading into a train wreck here, because Trump is, even though he says he's kind of a free market capitalist, he is a capitalist, but not so much a free market capitalist. He likes to manipulate it. I mean, 10% capital, credit card limits, 50-year mortgages, buy this, he is manipulating the heck. He's trying to manipulate the heck out of the economy. So he's not so much a free market guy, but he is a capitalist guy. But I think he's going to lose all of right around August. I mean, Trump. I think that Trump only has till now until the into July, and you could say now until the beginning of July. So the clock is really ticking on Trump and his administration to do stuff, if you will, especially anything that needs to be done through Congress. Like the credit card stuff has to go through Congress. He can't do that on his own.
Mm-hmm. And that takes
He's
time.
going to, yeah. So, people keep talking about how the Trump administration, going into this year, they basically been putting everything in lining everything up to be positive. But once you kind of lose your ability to do stuff, which I think is going to happen around July, the vibe is going to turn negative. When the vibe turns negative, which I think will happen here in the second half of the year. It's kind of a Katie bar the door situation, I believe. And I've been saying, in my newsletter, I said that this year, 2026, is the last year of American greatness. They call it American exceptionalism.
Saying that.
I call it American greatness. America's been basically a great country. 250 years. And the irony is that in July, we're going to have our 250 years anniversary. It's like, that's the end. I mean, we're going to be celebrating the end, which is ironic.
Okay. So given all of this, one thing I want to say, I love how you said inflation is the kryptonite of debt. That's such a great quote. So thank you for that, because it's so true. Given all this, how are you personally structuring your portfolio for 2026 for the next 6 months? And then I will add on to that, what mistakes do you see long-term investors? You talked about the boomers and that. What mistakes are they making right now?
Yeah. The one thing for me, so I'm a speculator. I speculate in gold and silver mining stocks. Mm-hmm. So it's hard for me to say, oh, they're making a mistake. They're not owning gold and silver mining stocks. But people invest year to year. Gold and silver is not investing. It's speculating. And we are literally betting on the gold silver price. But there's no guarantee gold and silver prices are going higher. I mean, you could easily lose money. You only invest in gold and silver what you can afford to lose. Gold and silver is really about people that are kind of true believers, if you will. I equate gold and silver to crypto, and I own crypto. I think they're both speculative investments. Both of them are. Mm-hmm. And people are like, don't invest in crypto. That's a scam. It's not worth anything. Yeah, it's high risk. Well, so is gold and silver mining stocks. They're high risk as well. Right. But what am I investing in? I'm investing in quality mining stocks. I like to be overweight gold and silver producers, overweight gold and silver developers, quality. I want to own a lot of quality. And then, everything, but I want to be, 70% in those with high quality. I feel that gold and silver prices are going higher. If I own those, I basically have an edge if I'm right about my macro outlook and gold and silver prices go higher. Now, I have been right because gold and silver have been absolutely ripping. So my portfolio looks absolutely fabulous because I got in early, and now it's kind of hard to chase this. Mm-hmm. But I do think we still are early enough. But if you want to speculate with your money, I think the ETFs are a really good opportunity here. The gold and silver, there's about 4 or 5 ETFs in both gold and silver mining stocks. And I think those are kind of a good way to play it if you want to speculate on higher gold and silver prices. The ETFs make it easy because you don't have to analyze these stocks. But me, I like to focus on the quality and then do the outliers for the high alpha. Chase the high alpha stocks, because in mining you can make baggers. I call them baggers, right? Yep. Each bag's 100%. You can make baggers in the miners, and so as a speculator, to me that's very attractive. And now with the macro situation, it's just getting better and better and better for gold. And like I said, silver is going to follow gold.
Okay. Well, Don, anything else you'd like to add before we close up here?
No, I think that's a good overview of the situation. I guess I'll say a little bit about the near term,
Yes.
about kind of what we can expect here. So I said earlier that I don't think the S&P is really, because Wall Street is so, the narrative right now on Wall Street is so potent. They're basically, there's no fear on Wall Street right now, and everybody seems to believe that we don't need leadership in AI anymore. Nvidia, their stock's down, and the Max 7 is not doing really that great right now. But they're getting rotation, and they're saying this is good. Rotation's good. Rotation's not good, people. You need leadership, rotation, but and so I think the rotation is basically a big warning sign, because you got to have leadership, especially when the rotation is like into healthcare, which is a government supported industry.
Excellent point. Yep.
So I'm not a big fan of that, but I do think that this is kind of an opportunity here to get in on the miners, kind of when we have this, kind of this calm before the storm. But because I do think gold and silver are going to go higher this year, but simultaneous to that, you never get a free ride with gold and silver mining stocks.
Mm.
I've been doing this for 20 years. They are going to be volatile. I would say 90% of the stocks that I've purchased over 20 years have been underwater at one point or another,
Hmm.
because you always get a correction. You always get these deep corrections. Like, in October, we basically had 22% correction in the HUI. So that's the miners index, 22%. So most people's portfolio was down 25 to 30% in 1 month. So you're going to get this volatility.
Hmm.
But I think over the course of the year, we're going to see about probably 4 or 5 corrections. But hopefully, of those 5 corrections in gold, only one of them is significant. The other are really shallow and short. I
Hmm.
think we're going to see a lot of shallow and short corrections in gold, and those will be buy the dip opportunities. So if you dollar cost average the months that were down, the correction months, you buy more.
Yeah.
Yeah, so you dollar cost average, and then you buy more on the correction months. And I think there's going to be at least 3, 4, 5 buying opportunities, correction opportunities, where you can add a little more if you're doing call it dollar cost averaging. But so I'll end it there.
Oh, well, incredibly insightful as always, Don. Thank you for those final thoughts. And of course, for viewers, listeners who want deeper data, analysis, or just ongoing coverage of the gold and silver mining space, you must find Don's work at goldstockdata.com. I so appreciate these interviews, as you reminded me, monthly, but it just feels like so much changes every time we talk, and everything you're predicting happens. So, Don,
Yeah.
thank you so much for joining us. And thanks
It's
for, listen, thanks for helping us navigate what's shaping up to be a very consequential year, it sounds like, for the markets. So,
Yes, yes, it's going to be very fun. At the end of the year, somebody can watch all 12 of them, right? And watch
right.
them back to back to back to back,
He was
um,
right.
and,
What?
and see how the year unfolds. And then, yeah, and then, because I think by the end of this year, we're going to know exactly what's going to happen the rest of the decade. This
Mm.
this year is going to set it all up, I believe. So we'll see. See you next month, Ashley.